Now, we did have a question that came in via email, and this was from Shishir earlier today. And Shishir asked, given the sell warning on the market sentiment tool, how should covered call candidates be chosen? Are monthly better than weekly? And if the stock falls after a covered call is open, then what are the management options and when should they be applied for weekly or monthly? All right, well, we're going to delve into this. We have had conversations before on using the market sentiment tool for trade management, trade adjustments, what the market sentiment tool means. We're, of course, going to review that. And then we'll delve into the covered call comparison and the covered call adjustments that we might be able to look at. We might evaluate, of course, but that's also going to be dependent on what type of covered call you're in. There's different ways to trade covered calls. There's not just one way to trade a covered call position. And we'll talk about that in just a moment. First things first, let's go ahead and pause the screen. Let's navigate over to the Power Options suite of tools so we can take a look here at some of those topics I just mentioned and how we would apply them, of course, to not only our strategy in question, the covered call, but what does the market sentiment tool mean? So the market sentiment tool here on the main pods on the home page, you can change and adjust the different pods that are available. The market sentiment tool is a combination of 13 broad-based indicators that Ernie tested and looked at. He started originally with, I think, close to 60 or 70 different criteria and whittled it down, looking at which ones gave the best precursor and analysis of a market change from one direction or the other, or market shift one way or the other. Been a pretty hot market, and of course, we crossed that benchmark today. We see that the S&P 500 did close and did remain above 5,000 after 4 p.m. So we're hitting some new highs. VIX is back down below 13 again, dropping down into those lower levels, although it did have a slight movement today. But we're seeing a strong market. But of course, that always leads to the questions. Are we overbought? What is going on? And as we can see here, the market sentiment has turned into a sell warning. When I click on View Indicator Details, that's going to pull up a more in-depth view of the market sentiment tool. We see the 13 broad-based indicators that are being used. The put-call volume ratio over the entire market. The number of SPX stays up, almost going into a bearish mode as well, which would switch it to 5 bearish and 8 neutral. The SPX gap over the SMA 20 is almost right there. The percentage of stocks across, optionable stocks across the entire market that are above the SMA 20. Stocks hitting their new 52-week high or low. You see that's almost slipping into bearish as well. VIX has entered into a bearish value trend. The RSI of SPX is bearish now. Number of days over SMA 20 for SPX, number of days over the SMA 100. Gap over the SMA 100 has gone bearish. Percentage of stocks with the SMA 100, not there yet. And the MACD gap is almost into a bearish mode as well. So there's a potential to see this slip into 5, 6, or 7 bearish indicators, with only 4 or 3 remaining in neutral in that case. Nothing is really close to going into the bullish indicators at this time. So with this concern here, now this is from the other day. This might actually change as we're looking at the market sentiment tool. It updates around this time every day. It's just updated once per day. Now, what does these bearish and bullish signals mean? Well, let's just take put call volume ratio. What we're looking at here is a histogram of any time that the put call volume ratio has hit any of these numerical values. And the fences are set. It's bearish when it's at 0.60, meaning that there's a lot more calls than puts for the volume. And when it's about 0.99 or just about 1, that's when it starts indicating a bullish. So what that means is when we see these values, let's take 0.6 for example, rarely do we see the put call volume ratio continue to drop to lower levels. So here we are at around the 0.6 value, currently where we are right now. And very rarely do we see it enter into these ranges and stay there. It wants to move back up into this range. And how is that going to move back into the range? Well, these numbers are going to start going higher. It's going to start moving from 0.6 to maybe 0.7, maybe to 0.8. because more investors now are buying puts than calls, or less investors are buying calls at that time. Now, historically, that's the trend that we get to see. So when we hit this level here of 0.99, very infrequently does it go up to these higher levels. It usually comes back. So that's when we see that bullish indicator on the opposite end, when we start to get too many puts bought instead of the calls. And of course, you can see this historically for each individual indicator. You can click on versus SPX. And this time frame here just shows us back a little bit. But when the market sentiment, this particular sentiment hit a certain point, you can see there's an inflection point there when the market fell and it went up to 1.1. Well, hey, that was getting into the range when it was going to flip. How is it going to flip? The market was going to start moving up, and we were going to start seeing these lower levels on the red line for that indicator. And of course, this goes back beyond that. It goes back, if I'm not mistaken, to 2008 historically. It's harder to see, but you can scan through and go back to 2008 to see the various histograms and performance of the different market movements. Wow, SPX at 1280 back in 2008. That's kind of an interesting thing to see there, isn't it? Also, all right. So each one of those has a specific fence set. And these, of course, are what I mean by how they were tested by Ernie as indicators, leading indicators of bearish or bullish fences when these ranges are hit for all 13 of the indicators. Now, although the sell warning has appeared, and I think this is the third day or second day right now, the sell warning, we're going to see it update in a little bit to February 9th, of course, the close of today. But in general, what I tend to look for when looking to maybe close or adjust bullish positions, calendar spreads that I might have open, bull put credit spreads, for example, when I start to see these strong bearish sell warnings, usually 2 in a row, that when we start hitting that 7 range or start hitting that 8 range, when I start to see 2 in a row, that's typically when I'm looking to make a decision of, I've got a bull put credit spread. Should I close most of my bull put credit spreads that have a profit right now? Should I lighten up on some of the contract sizes? Should I add a protective put short term to maybe my covered calls to create a collar? Or maybe to my calendar spreads, my diagonal calendar spreads, quote unquote, poor man's covered calls, to add a little bit of protection to hedge against the decline. Or maybe at this point, usually we see the VIX back on 1219 when these bearish sells started to come in, the market was going up to 47.68 and so forth. The VIX was down where it is now. So maybe buying calls on the VIX or puts on SPY as a market hedge. And with covered calls, Shishir, I might say the same thing. If you have those strong bearish sells 2 in a row, that's when you might want to consider taking action. I don't really take the sell warning, hey, it's there, it's in my mind, I might want to lighten up on some positions, but I haven't yet. But when I start seeing the strong bearish sell warnings 2 or 3 in a row, that's when I'm closer and starting to take action on some of that more exposure, whether by protecting it. If I have a covered call portfolio, I might buy puts on SPX or SPY. If I'm heavier in NASDAQ stocks in my covered call portfolio, I might be buying puts on QQQ or NDX. I might be buying calls on the VIX as a market hedge as well. If I have some covered calls that are near profit levels, so let's say I did a covered call and I could make a 2.5% return. If I could liquidate right now for maybe a 1.7 or 1.8% return, maybe 75 to 80% of the max return I expected, I might consider liquidating the position at that time and seeing what the market has in store for us going forward. Now, this did lead an indication down to the 4,600 level, but the market continued to move back up after we hit those neutral zones, and now we're starting to hit those initial sell warnings once again as we're going above. Down below, you see what the market reaction has been when we see the buy warnings. So you can see here, when we were back down at 4,100, when we had that sort of extended decline, we started to see the strong buy and bullish buy warnings, and the market started to ramp up for us. We started to see those sell warnings here I just mentioned around mid-December, and there was that little pullback here, but then it continued to rally back up. We've been in neutral, and we're starting just to get those light sell warnings again. But it's usually here. So last time we got some of those bearish sell warnings was up here. And that was sort of a precursor of this decline, little fight back, and then the further decline as well. And of course, on this market sentiment tool, you might not have the full history. This is a webinar account that we're using. It's just a 14-day free trial, but it does have some extra perks on it because we use it for the webinar. But I can go back and take a look at other results here. When we saw the strong buy warnings when the SPX down in 2022 hit the 3,600 level, those bullish buys started to appear. And then we started to see some sell warnings back up here at the peak at 42, drop back down to 39, got our bullish buy warnings again, had those rises, a little hiccup here with the bearish sells. And you can go back and see that historically here. Get there in that near bottom down here at 3,900 and back to 3,700 back in June of 2022. Bullish buy warnings, very bullish buy warnings were being triggered. Saw that movement back up. The sell warning started triggering here, 8:01 middle of August, and we started to see the decline. Some fight back here with the bullish buy warnings up a little bit, and then the decline continued as well. So you can take a look at that and see how it operates in those situations. But again, typically what I look for when planning to make adjustments, extra protection, lighten up on bullish positions, is when I see two of the bearish sell or very bearish sells in a row. The deep red, not the light pink, just sell warning. But when I see those Shishir, that's when I look to do that as well.